Take a look at the IPO market for a bit. The IPO market in India continues to see a flurry of activity. India, along with the US and China, accounted for the bulk of IPO activity during the third quarter of the year, and this is as per EY. Firms across a range of sectors is what you're looking at that have tapped the primary market. So whether that be LG Electronics, Tata Capital, and not just the larger firms that you're looking at, add to this list also small and mid-sized companies and also startups, the likes of Grow, Pine Labs, Lenskart. All in all, every few months, there is a new company that is hitting the headlines, promising to be the next big thing on the Lal Street. And according to a Kotak Institutional Equities report, of the total 1.17 lakh crore rupees that were raised in the Indian primary market so far this year, approximately one-third, or around 43,000 crore rupees, represents exits by existing investors or promoters through offer for sale transactions. Now let's try and put all of this into perspective and also understand what this really means when it comes to retail investors and try and figure out what they could do to also safeguard their interest. In fact, on the show right now, we do have Narendra Solanki, who's the head of Fundamental Research Investment Services, Anand Rathi Shares and Stockbrokers, as well as Avinash Gorakshakar, founder and head research, Avinash Mentor Research Services. Thank you so much for taking time out and joining us this evening. Well, first things first, Mr. Solanki, I'll take it across to you. Do you think there needs to be a distinction that right now, there needs to be made between IPOs that are raising money purely to be investing it back into the company and the ones that are doing so to simply provide an exit to the angel investors or a chance to exit at this point? Do you think there needs to be a clearer distinction when it comes to investors looking at some of these IPOs?
Yeah, good evening, everybody. I think as far as distinction or the awareness is concerned, I think the present rules are sufficient enough, wherein the company or the IPO, the company which is coming out with an IPO already discloses the amount of funding which they are raising, either it is pure fresh book building or it is just an offer for sale. So I think it's sufficient enough, and don't see any alarming need for further distinction regarding that.
Absolutely, Mr. Solanki, and that is about the rules, right? But I'm just talking about the prudence when it comes to investors that are looking at some of these IPOs. Do you think they also need to be keeping a distinction in their mind when it comes to what is the primary purpose of the IPO that they're looking at?
Yeah, so definitely as an investor who is trying to invest into IPO, so definitely one has to look at it, what kind of valuations they are investing in, whether they are comfortable with the valuations or not, and whether the IPO or the company which is coming out with an offer is actually fitting into their own perspective of what they want in terms of return and risk which they are trying to achieve for their own capital. So I think these all things are individual, and I think investors should be evaluating all these things before actually trying to put the money, and not just to fall for the crowd and the fanfare of the company. And instead, they should be evaluating the company in terms of valuations and their own return and risk expectations which they have for their own capital. So that is the primary homework that each and every investor should do before investing in any IPO.
Right, and that's some word of caution coming in terms of prudence in terms of these investors. But tell you what, Mr. Gorakshakar, I also wanted to come across to you. Some IPOs, of course, turn out to be stepping stones to fortune, while others also quietly drain investor savings, right? So why are people still chasing them? Is it simply out of the fear of missing out? Is the FOMO factor something that you're also looking at that is now sort of looming large when it comes to investors?
Yeah, good evening. See, first of all, when you talk about the FOMO factor, I think most of the retail investors get excited when any large, marquee investor comes in as an anchor investor. I think the typical example is Arcade Money, who has come in as a kind of a strategic investor in Lenskart. So, that creates a lot of hype in these IPOs, despite the fact that valuations may seem a little expensive, the valuations may not even be justified. But I think at the end of the day, today the new breed of investors who are coming in are willing enough to take a lot of risk, and they don't mind, investing in companies, where the valuations are slightly out of the box, or maybe there's very little room on the table for earning money. I think most of the investors are momentum investors. They want to make listing gains. But I think one thing which I would like to tell all your viewers is that the new issue market for the listing game is now completely over. Very few companies like LG Electronics, which got oversubscribed heavily and also got listed at a significant premium. These are very rare cases. But I think most of the IPOs which are coming out now are priced to perfection. And I think it makes a lot of sense for retail investors to evaluate all these companies not only on the business but on the valuation comfort also. So my sense is that if you are going to subscribe to high priced IPOs, then you run the risk of possibly in the short term the stock may not perform as what you think. Only in the longer term good value can be made.
Alright, so if you're looking at a listing pop, you need to be a little more careful. That's the word coming in there as well. But let's also talk about valuations, right? And that is also a very important point that Mr. Gurakshakar has also brought up in terms of valuations. This is a market that has become largely very crowded. Despite that, you do have select startups, Mr. Solanki, that have had sky-high valuations, or at least that's what the social media storm seems to be calling them. Are these valuations then justified in your opinion, and what do you think about the valuation side of it all?
I think as far as valuations are concerned, it's very subjective thing. And in terms of practicality, there is no single formula or a method where you can say this, okay, 2 plus 2 equals to 4. So anything higher than this is pricey and lower than this is. So having said that, I think before actually coming out with a judgment of higher valuation or lower valuation, I think we have to see what kind of a business the company is into and at which stage the company itself into the cycle. So right now, generally what we have seen that almost on an average, these companies are at a very early stage in their business cycles. And in terms of market penetration or in terms of runway for growth, there's a huge runway for growth. Looking at the market size, even in India, and forget about the tapping markets outside India. So the companies who are trying to tap market outside India, so they have huge runway for growth. Now it just depends upon at how soon the company increases its market share and how soon the company leverages its how soon the company achieves its operating leverage. So that is these are the two things: so revenue growth and the profitability. How soon it will be profitable. So I think you have to see individually for all these companies these kind of metrics, and then probably you can decide whether what you are paying right now for the company's earnings, whether in terms of price to sales or in terms of price to earnings, if it's already profitable. So this is how you can actually make a judgment. But yeah, historically, if you analyze, so definitely right now, the average valuations have trended higher in terms of what we can say the kind of IPOs which were coming, let's say 3 to 5 years back. So the trend has shifted towards higher side in terms of average valuation. But yeah, you also have to see businesses individually rather than brushing them off just by looking at the numbers.
All right, then that's the word coming in, a word of caution, if you will, when it comes to valuations. Some of them are becoming a little bit stretched. But what do you think, Mr. Gurakshakar, retail investors should then be doing to safeguard their interests? Then how do they look beyond the glamour of ringing bells and implications of a listing pop that you've talked about, right? Is there really a case to really sharpen their focus when it comes to research on the fundamentals of the company that they're looking at as well?
No, I think first of all, a very simple thing is that investors should not be carried away by the hype. I think we have seen examples like Paytm, Nykaa. These were clear cases of selling the narrative and not having the cash flow. So I think today Paytm has not even reached the IPO price at what it issued the shares. So definitely investors in these cases are completely they lose a lot of capital in the longer term. My sense is that I think even if the narrative is strong, the runway is very strong, I think it doesn't make sense to buy the stock at any rich valuation. So it's better to wait for the stock to get listed. Typically what we see is after say 3 to 6 months, the excitement in such kind of IPOs dies out. You get the stock more or less at the IPO price or sometimes even below the IPO price. That would be a good entry point because smart investors definitely who are wanting to make long-term value, they would obviously get the best ROI only when they buy at the right price. So my sense is there's no hurry which investors should do in applying for these IPOs because clearly this is a momentum game. I think over the next 3 to 6 months, if the performance does not meet to market expectations, I'm quite sure that there could be a selling wave, and this definitely is a very natural corollary. So my sense is that investors should be very, very selective. I think LG was an exception. But if you look at the other IPOs which are hitting the market now, I think clearly, it's a word of caution. I think, investors would learn the hard way. So it's better to be selective and not go for every IPO which comes with a public offering.
All right, and so you can't be choosing every single IPO, and that's not something that is prudent as well. That's the word coming in there. Mr. Solanki, I also wanted to take a look at the bigger picture for a bit, because the next $1 trillion of the economy, do you think angel investors can be significantly sort of contributing to that as well? How are you looking at it in terms of the bigger picture, in terms of the contribution of angel investors then?
I think they have a very, very important part to play because these are the persons who actually take greater risk in terms of deploying the capital in a uncertain environment with higher risk appetite. And definitely, there are a lot of areas within our own economy which actually needs these kind of high risk capital, wherein the success is not 100% guaranteed or even 50% guaranteed. So these could be anything like development of products, research and development into areas like defense. Then you have pharmaceutical areas wherein you need a lot of capital in terms of high R&D. So likewise, in electronic manufacturing services, building different kind of nano chips. So there are a lot of sectors wherein you need high risk capital. So I think definitely the role of angel investors would be there because our economy is into a very growing stage, and I think the need for these kind of capital would definitely be there for at least next 10 to 15 years.